The stock market might hit an extreme slowdown, for the next 10 years, at least according to Goldman Sachs. They now believe that for the next 10 years, the stock market is going to return an average of just 3%. For context, the last 10 years, it had been returning 13%. With this year in 2024, we're getting a 20% return. So what exactly is going on here? What are they factoring in? Are they right? Should we be concerned? And if so, what in the world should we do? Let's go ahead and break it down. Like always, especially when it is a pretty big topic like this, I want to start by setting the table, but also near the middle and especially at the end of the video, I'm going to tell you some things that you should do. I'm going to leave you with some potential solutions that you can employ if this is going to be accurate. Okay, but first, like always, let's set the table because I'm an educator. Okay, I want to make sure that you know all the terms and all the players here as we jump into it. So first, they're looking at the S&P 500. That is the 500 largest companies within the US. That is what they're looking at when we talk about the stock market. Who is they? They are Goldman Sachs. They are an investment bank, one of the most famous in the world. They're known for doing some things. Now, they have a checkered past, and one of them is causing the 2008 recession. Take that how you want. But they're an investment bank. Primarily, they do a lot of things, but primarily, they are responsible for, other than investing people's money, they take companies public. That's what an investment bank does at the end of the day. Essentially, let's say you are Google, you want to offer your stock to the public, you go to Goldman Sachs, they help you do that process. That's super, super, super simple. Okay. But they have put out a prediction and they say, look, we think over the next 10 years for 5 main factors, we think the stock market is not going to give you what it used to give you. You were getting 13%. You were used to it. You liked it. You loved it. That's why this channel is here. Now you're going to get 3. That is a little concerning, especially when inflation is what it is today, which is very close to 3. We're not making no money. If inflation is going to remain consistent and the same, which is not great for us right now, and the stock market is going to be that, our money is not growing. That would be a major concern. If inflation were to pick up over the next 10 years, we would have some conflicts. Okay, so first, why did they think this? Again, they have 5 factors. I'm going to pull out some of the main ones. The first one was interest rates. They think that interest rates are elevated and that is going to remain the same. I feel kind of meh around that. So interest rates we've talked about plenty of times before. You can obviously check out tons of videos that we talked about on interest rates here on the channel. The Fed did cut interest rates, so they did come down a bit. Where they're going to go over the next 10 years, I don't know. I have no idea what they think, where they think interest rates are going to go over the next 10 years because they can change on a dime. Interest rates are, I can't call them fickle because they do kind of plan these things out, but there's no telling where interest rates can go. If they go lower, they usually help the stock market go higher. So there's that. There are some that think interest rates could be cut further. There are others that say it can stay consistent. My bet, if you ask me, I think they're going to stay consistent at least through halfway through 2025. But I honestly don't know. I honestly do not know where they're going to go. I would have to read up more. But again, that is really dependent on how the economy goes. It could be dependent on who wins the election. There are just so many question marks on where interest rates go. So how they would know where they think it's going to go for 10 years is, I don't know. I would need to see the spreadsheet. I need to see the math on that one. So that's one thing that they factored in. The other thing was concentration. This was very important. Concentration in terms of the entire S&P 500 right now. You have 500 companies. However, depending on how you look, between 30 to like 45, almost 47% of the returns and the value of the entire S&P 500, depending on how you want to look at it, is really concentrated within just 10 stocks. Okay? You got 500 companies, but the vast majority of it, of the value and the strength of it, is just 10 stocks. Really think about that. And we're talking, you know the stocks. They're all in tech space. You're talking about Meta, Google, Amazon, Nvidia, Microsoft. That's 5. and the other 5 tech stocks you're probably thinking about in your head right now. And clearly I didn't memorize them all. And we talked about this concentration problem in the past. When those stocks do well, and we talked about earnings week, when these companies come out and say, hey, we did this, we did that, we expect to do even better the next year or the next quarter. When those stocks do well, the entire stock market does well. That is because they're pulling the entire weight of the entire stock market on their back. Well, they believe that this is going to be a problem moving forward in the next 10 years. And they might be right. They also think that competition with other asset classes and even across the globe could be an issue as well, and that is fair. That is fair. We could get more into the diversification argument there too, but I do think that is going to be somewhat of an issue, and it is something that I have brought up many times that, hey, it's a lot of money in NVIDIA already. How much higher can they go? And I mean, look, you have 500 companies out here. It can't all be weighed in NVIDIA. It can't be the NVIDIA index, okay? So that is something that they did bring up. But is it going to bring the entire stock market from 13% a year on average down to 3%? Question mark. Okay, that is something that, you know, makes me raise an eyebrow. Next here, or the next thing they brought up here, was the frequency of downturns. They think the frequency of the downturns in the stock market and or the economy is going to happen more frequent than what it had occurred in the past. Now, when it comes to recessions, if you ask me, and I guess you are asking me, so there's that, they are relatively unpredictable. I can't say they're unavoidable. I would say that recessions in some ways can be avoided. Ask Australia. Australia has done very, very well avoiding recessions. They have a very good history of avoiding recessions and not having many in their history. I'm not going to give you an economic lesson as to how and why that's the case. We get into that if you want me to later. But in the United States, we have had recessions roughly every 10 years. Now, the issue here is this. They always come, like any emergency, when you don't really expect them to. No one would have saw COVID really coming like that. It's just not like, hey, this thing is going to happen on this date, recession's coming, everybody sell, everybody get ready. I mean, Robert Kiyosaki, every year, the author of Rich Dad Poor Dad, puts out some crazy tweet about a recession coming. He going to be right one day. Buy cans and beans or whatever in the world he talks about. So there's always somebody crying wolf around some crazy recession theory. But honestly, you never really know when they're coming or why. It's hard to really call. And when we talk about the stock market crashing, I mean, those are usually kind of up in the air too at times. But again, they do tend to happen every 10 years or so. But the frequency of them within 10 years, that's very, very difficult to call. And we're going to come back to that as well, because my birthday is coming up next week. I'll be 35. You want to round it up and call it 40, which means that I should have hit, or at least seen, around four stock market crashes in my lifetime. If I'm going just in memory, right? Not, I wasn't an investor for all of those almost 40 times or 40 years, then again, I'm only 35 and not 40. But from my memory, right? I'm not looking at a chart, but I've got the .99 2000s, 99 and 2000s. But the dot-com bust would have been the first one that I basically remember. Though again, I was an investor. Then the 2008 crash, and then I have the COVID crash, and then 2022, the market was absolutely down, and it was an official recession, but we did have 2 quarters of negative GDP, so that's 4. Now, the stock market was down in 2018, but not enough to really hit anything. So that's really 4. Now, is the stock market going to crash? Is it going to be a recession in the next 10 years? I would say yes. I would assume that it is going to happen. So, yeah, it's probably going to be at least 1. But to say it's going to be several, is it going to be more than what we have normally seen? It's hard to call. But I would imagine, between now, 35 for me, almost 35, and 40, and to say we're probably going to have at least 1 more crash, I mean, that would be normal. That would almost be normal. But also we have had periods, we had one between, I think it was 2009 is when the stock market started to recover, 2009, 2010, all the way up until 2020, where we had, with the exception of 2018, we almost no crashes at all. So, or no negative years for the stock market at all, really between at the end of the Great Recession up until 2018, because that was the only negative year that we had. So that was a bull run for the ages, the longest that we have had. So it's possible. It's possible to not have one, and it is normal to have at least one. So I wouldn't be overly concerned. Now again, all of these are from Mary, so correct me if I'm wrong in the comments, but I don't really think that, I don't know if we're gonna have I'd be shocked. I'd be shocked if half of the next 10 years we see a down market. I'll say that. But again, correct me if I'm wrong in the comments. Clearly from 89 to like 2000, I wasn't an investor, so I could have missed a down market or two. Okay, so forgive me for that. But here's the thing. Can they be right? Are they right? Are they accurate at these predictions at all? Here's the thing. 10 years is a long time. I'm not putting no credit in nobody's 10-year prediction. Okay, even for me, when it comes to what I think is valuable and what I think is good for a stock or what I can fathom, I only go out a year at most. It is nearly impossible to say for the next 10 years, I feel confident about what is going to happen other than the fact that things are going to be different. And here's why. There are so many factors. Like when we talk about interest rates, there's going to be a whole new Fed chair, a whole new Congress, a whole new president. So many things are going to be different between now and then. Think about where we were 2 years ago. Companies like Nvidia, companies like Meta, all tech stocks really, around this time last year were absolutely in the tank. 2 years ago around this time, you were just finding out about what this ChatGPT thing was. Look at what it has done now. It writes papers. It does all this type of stuff. Can help you get dressed and get your fashion game together. It's gonna help me out this weekend. But it can do all of these things that were unfathomable 2 years ago. So it is inconceivable to me as to how you would know where we're gonna be 10 years from now. And even think about the AI boom and how Nvidia went from a company that was out in the absolute toilet in 2022 to being, and I think most people knew what Nvidia was, and it was a solid stock before 2022, but now being the most valuable company on the face of the earth. I don't think that was really, in the cards like that. So now we're in the age of AI, and that is the thing, and that's every company wants to incorporate that in one way or another, and that is something that's happened in the last 2 years. I mean, we went from Web3 to the metaverse and how that was the thing. We talked about how blockchain was the thing. Like, you guys see how quickly these things change within a year, 2 years, 3 years. In 10 years, there's no way, absolutely no way they have a beat on where we're going to be and be accurate in 10 years. And speaking of that, remember where we were at the end of 2022 and where we were at the end of 2023. It's the same Goldman Sachs that said we were supposed to be a 65% chance or so in a recession. That has not occurred. It's the same Goldman Sachs, same Bank of America, same Merrill Lynch that said that we were supposed to have up to 2, maybe even 3 rate cuts. You can go back and check the videos. We had the receipts, several receipts that said how many times they thought we were going to see an interest rate cut this year in 2024. They were all wrong. We got 1, and we got that near the end of this year. Now we still got 2.5 months left, so it is possible that we get 2 more shots. Right, October's almost done, so it may happen in December. It may happen in November. Did those out of order, November and December. We'll see. But they were supposed to happen way back in the summer and even in Q1. That was off. So if you were off about a 1-year prediction, you could be you could be a galaxy away around what you think could happen over the next 10 years. So really, if they are right, which I highly doubt that they are, but you always want to be ready, what happens if they are right? What should we do to prepare? got a few tips for you there as well. So the first thing is, it is possible that the S&P 500 could return 3% over the next 10 years. If that is the case, remember, the S&P 500, which is the entire stock market, can do one thing. Individual stocks can do something different. That is just an average. So you still have the option to invest in individual stocks. You can do both. Okay, so that is one way to kind of semi-diversify your portfolio and say, look, I may still own the S&P 500, but I'm still going to own stocks A, B, and C that are doing way better. That is where I'm going to concentrate more of my money to ensure that to try even to get more than just the 3% that the stock market is giving me, if that is going to be the return. So that's one thing that you can try and do. More diversification. It's not just the stock market that's going to be out there. I can almost guarantee you, because it's 10 years, I can't guarantee nothing other than the fact that it'll be 10 years from now and the things are going to be different. But if that's going to be the case, people are not going to just invest in the stock market. Diversify your chicken, which is what Marshawn Lynch would say. But you can invest in real estate, invest in bonds. If crypto is still here, we'll see in 10 years, but I would think that it would be. But if that's going to be the case, perhaps it's more solid, perhaps there's more regulation, perhaps we know it is safer at that point in time, which I hope that it is. I hope that it is. I am rooting for crypto. I hope that it is more safe and that things are way better now than what it is then or what it is now. But if that's the case, perhaps people are moving towards that. And that is a better place to invest at that point in time if the stock market is only giving 3%. So you can diversify into different asset classes. So real estate, maybe it's crypto, maybe it's a business, maybe it's bonds. Maybe you can put your money in those different areas, and that it could be a way that you can generate more than 3%. Maybe interest rates are in a place where even putting your money in savings accounts could be better. We will see, and we will evaluate when the time comes. We'll see when the time comes. Right now, today, I don't think there are any moves that need to be made, because today the stock market is up nearly 20%. Also, I think the main thing here, don't panic. Today, it don't make sense to panic. It does not make sense to panic here in 2024 about what somebody says they think is going to happen in 2034. That doesn't make sense. They could be, and are most likely, completely inaccurate in that. It is good and valuable to know to what degree what they have on their minds, because these are threats. How credible those threats are, that's a question mark, but it is good to know, hey, things are concentrated. There is a risk that what we are used to, 13% of the last 10 years, might not be what we expect before, because there have been periods where the stock market did not return 13%. There were periods where it was a bit lower. So do be ready. And the key thing is, have those tools in your toolkit. Be able to say, hey, look, I've got individual stocks I can go to if I need to. I have other asset classes I can go to if I need to. But be ready and have those tools in your toolkit so you can shift whenever those times are available and whenever the time arises. For quick story time and just quick example before we roll out. One of the things my dad taught me and told me as I was growing up, when I was 16, got my first car and started driving. So I'm giving you my near 35-year-old wisdom, was there were a few things that you need in your car. Like as a man, as you're going out there driving, there's a few things that you need, right? Everybody needs a spare tire. Everybody needs or should have, the jumper cables and all kind of stuff. But outside of all that, he's like, always have a jacket, always have a blanket, because you never know when you could be steering on the road and it could be cold, right? You give it to your girlfriend, give it to your wife or your kids at this point in time, because I'm older, and you just might need it to be warm. Have I ever actually needed it? I think like once in my entire life at this point in time. Hopefully I never need it. But this is that time, right? This is that warning, that period. It's like, hey, look, I don't think this is going to happen, Goldman Sachs. I highly doubt you know what you're talking about. However, I do have, this, and this, just in case that's where the stock market goes. So should it happen, should I get a flat tire, should the stock market just provide 3% for the next 2 or 3 years, I know exactly what I need to do and how to do it, so I'm not fumbling around getting next to nothing and watching inflation tear my portfolio apart sitting on my hands and not knowing what to do. That is the point, and that is really the key learning that you should pull from this. Now, the next question is, well, what are some of those stocks I should look at right now? What are some things I should research today, or perhaps add to my portfolio right now? And then obviously every 6 months you can refresh that. What are some of those stocks, and are some of those stocks, you know, perhaps under $50? If you are looking for those, this is the video you want to watch next.